Welcome to Behind the Ticker. I'm Brad Roth, Chief Investment Officer of THOR Financial Technologies and Portfolio Manager of THLV, the THOR Low Volatility ETF. Behind the Ticker uncovers the inner workings of the ETF industry. We will interview portfolio managers and ETF service providers to dive deep into their work lives and their businesses. We will learn the inner workings of their strategies and what drives them as they continue to grow their company. Many of these individuals are entrepreneurs and will have unique and compelling insights to share as much goes on behind the ticker. Please note, nothing in this show is investment advice, and it is meant solely for educational and entertainment purposes only. Welcome to Behind the Ticker. Today we have Mr. John Forlines from Donoghue Forlines. They have a really unique and diversified business. They do have a model portfolio business, they have an ETF business, and they also have a mutual fund business. John is a finance veteran, started at some of the larger institutions until he started his foray into entrepreneurship and running his own firms. So today we're going to talk specifically about their enhanced real asset ETF, which is ticker DFRA. They also have a high yield ETF and a risk managed innovation ETF that we touch on. And we also hit very quickly their mutual fund business. John's a great guy. Really think you're going to enjoy this conversation with Mr. John Forlines. Hey, John, welcome to the show.
Hey, Brad. Thanks for having me. I appreciate the time.
So today we have John Forlines from Donoghue Forlines. We're going to talk about DFRA, which is their yield enhanced real estate ETF. But before we get into it, John, I always like to hear about your background and how you got into the position that you are today.
I ask myself that question every day. Long and short story is I've sort of been in a lot of different places. I started out actually as a English and economics major in school, and then came to New York because nobody was hiring job. We didn't have any jobs back in the time I graduated. It was just, you probably recall, it was the time of the 21% prime. So went back to law school and came back to New York and worked as a lawyer for about 4.5 years and secured, basically in what you'd call the predecessors to what ETFs are today. It was in structured products, building vehicles for banks and institutions that allow them to, say, take a view on the DAX versus the NASDAQ or et cetera, and also have yield attached to it. So there were floors, caps, collars, you name it. It was a derivatives business. It's very similar to the process that goes into selecting ETFs for a portfolio, basically.
Mm-hmm.
So that's how I got started. And then I went through a number of career permutations. JP Morgan at the time where I went was, after practicing law, was in tremendous flux. It was they had the view, which was correct, that Glass-Steagall was going to go down under the Clinton administration. And so a number of us who had worked in London had been seconded back to New York to essentially build an investment bank because they knew we were going to get powers to underwrite debt, equities, et cetera. And so that's, I took over while I co-ran private equity for a bit, which was my introduction to sort of the innovation side of the world, because our largest single assignment was essentially helping liquidate a very large commercial bank portfolio of venture companies. They were trying to get out of it because of the real estate crash, the high interest rates I mentioned. And so that's where I really met a lot of people in the tech side of the business. And then the next job, of course, I had was to run with another Morgan partner, technology, media, and telecom. Okay. And so that's where I've had my technology event, which is, of course, one of our other ETS innovation. And so after that, in 2000, I was able to get out at kind of the market peak. It was just good timing, I think, more than anything else. And I helped Morgan liquidate a couple of their investments that we'd made as part of the tech process, and therefore I got my stock and equity and all that stuff out, which is good. and I started a family office, which exists today, which essentially does, I, I guess most of the thing you'd say it does over the period of time, which is now 20 some odd years, is to find financial services or fintech opportunities that I can either operate, or I found someone who's really good and I want to go in with them. And so that's what the predecessor firm, which merged in with Donoghue, was. It was essentially a quantitative and engineered ETF set of portfolios that were for broker dealers.
Mm-hmm.
And in 2009, that was actually a novel concept because there's only about 600 billion of ETFs outstanding, contrasted with the trillions that are now outstanding. And I remember going into brokers and with proposals to essentially sell them portfolios for own use to their advisors, and I'd have 6 to 7 pages in there on what an ETF is.
Yeah.
And it was amazing time. So I sold that company to Donoghue, which was a long-time Boston-based tactical manager, in 2017, and that's the resultant firm, which is Donoghue Forlines now, where we have a investment committee that essentially is more of an asset allocation committee now, because a lot of our, and you know this probably from your own firm, a lot of our stuff is built into the ETF itself, which includes stock screening and also in certain cases timing, and so our view is that the world's changed and you need to constantly refresh your product suite, and you need to do a lot of these, communicate to people about what you do, because the old models, I think, have since 2018-19 have changed a lot, and that's so that was a long answer to how I got here and what do I about my background, but that's a pretty good picture.
Yeah. Well, I'd say you made a good decision leaving being an English teacher or a history teacher that you mentioned. And, congratulations on your success. And before we jump into the firm, I always like to ask, what do you like to do when you're not working? What are some hobbies that you have that keep you busy outside the office?
So that's a great question. Number one, I've got 2 grandkids now. I like to be around them, so that's an easy answer, and it's also probably the most truthful one. So in terms of bid ask, if they're around and there's something else to do, I'll choose them.
Yeah.
And I like to work in gardens. So we've had two main properties since I've been up here in New York. And I've worked them all, and I'm now working on another one. So that's really good, cool. Moving dirt around, putting flowers and trees and stuff in. And then I don't know if you knew this or not, but I actually, and I saw you made a reference to teaching. I have 3 courses I teach at Duke University on one day in each semester. So I teach on Thursdays each semester. And it's in economics, and it's decision science oriented stuff. So that's a real passion too. I thought I'd do that for about 2 years back in 2012, but I've continued to do it, and I think it's something that I think about a lot, about how can you get better. Teaching's one of those things where, especially at university, where you're constantly challenged to get better every semester. If you just mail it in, students know that faster than anybody.
Yeah.
So,
well, all 3 of those things are really fulfilling, and so it's good to hear. I tried to plant my first garden this year. It is not going well, so maybe when we're off the call, I can ask some questions. But I don't have a single vegetable yet. But that's just me being a novice. So we're going to talk about DFRA, but before we do, let's talk about the firm as a whole. Can you explain what services that your firm offers outside of the fund business?
Yeah. So basically, the way, and this is post 2017, because prior to 2017, Donoghue Donoghue offered a suite of products that were mostly in the mutual fund field, along with some SMAs that were all around essentially risk on, risk off methodology. It's the best way to describe it. So, for example, if they had a dividend strategy, that dividend strategy would stay fully invested until certain market signals materialized, and then they would switch to some type of treasuries for a period of time. Excuse me. And what we brought is those engineered portfolios over, and it was a pretty good mix because all of a sudden we had a different mix of broker dealers that we were serving. They were serving a different kind of broker dealer. Mostly they were more on the RIA side.
Mm-hmm.
So it was a pretty good fit. But something really weird happened, and you probably remember this in 2018. Prior to 2018, most of us were using either BlackRock or State Street type products to build portfolios. And we had a great relationship. Ours was more with the BlackRock team, mainly because they were in New York. I was in New York, and back in 2009 and 10, they took a real interest in young firms like I had. So there's a lot of loyalty there. But what happened in 2017-18 is they decided to get into our business basically.
Yeah.
And worse, they started pricing their portfolios at zero.
Yep.
Meaning they were essentially offering prop products in a kind of a free wrapper. So that was a kind of a killer. We had to really act fast, but we did. We started transitioning our portfolios over so that we also had zero to low fees, and that's where we had to do a lot of engineering about. And fortunately, we had it, in all the different permutations of the funds and ETFs that we could build those portfolios to mimic what we were doing before without, with the third party products.
Yeah, I think for those of us who are kind of in the model management or portfolio management, direct to RIA or brokers, that race to zero is real, obviously, and it's a real challenge for us to be able to both of us to be able. We got to show our differentiation and why it's worth the fee that we need to charge because we definitely don't have the scale. But you and I we run very similar businesses, and I think we have the same investments philosophy in many ways. We cut the cookie differently, but in our opinion, in your opinion, I don't want to put words in your mouth, but the risk off stance is often important sometimes. And so why is it important for investors and advisors really to implement some strategies around sound risk management techniques over just buy and hold and modern portfolio theory?
Well, it's rooted in psychology, and it's rooted directly into behavioral science, really. And I always laugh because people say, "Gee, if you're Markowitz, who unfortunately passed away this week, or if you're running those long-term models, you just stay invested over the long haul. You might want to rebalance every now and then, big deal, but you'll do fine." And that is true.
Yep.
That is absolutely true. And then I guess it was probably around about 15 years ago. GMO came up with a seminal paper on basically you have to look at if you look at your portfolio that you're just managing your sister's money, you'll be out of business soon. And Schiller at Yale picked up on this, and he basically said, "Look, it's probably true. The long termist, Schiller won the Nobel Prize the same time as a long termist won. But if you do that, if you're an advisor, a money manager, and you run your business like that, every time a business cycle shifts over or there's radical change in the market, like a 2008, you're going to lose clients." So, and in truth, if the behavioral science part of it is that typically, if you look at the risk reward spectrum, people are much more likely, about 2.5, 3 times more likely to be risk averse with things like money and their health and other things that are important than gain seeking. So that's really what we both built our philosophy around, which is and we discussed this before, Brad. There's times when it can be painful as an advisor because the markets are going up because of monetary policy. There's nothing you can do about it, right? But to be poised to help out during those times of big, large drawdowns, I think, is an important function. And it's one of the reasons why there are firms like ours around, because enough people, believe that, gee, I don't have the emotional stability to make it through another 2008 again.
Right.
I'm very happy with a certain level of returns. And it's true. If you got a lot of folks and brokers who understand that strategy, one of the things you'll find out is when you have a really good year from a nominal standpoint, good return year, there's questions asked about you, like,
Yeah.
how come you did so well? Which is absolutely different from a lot of people's experience when they think about investment management. Gee, I got a lot of good returns. Well, that's not really the business, is it? The business is, how much risk did you manage along the way, and how much are you willing to tolerate? And so that's what our businesses are about. And it's a matter of constant communication, and especially in markets where, like this one, last few years, where we've been flooded with monetary um, um, stimulus, it's can be kind of daunting.
Yeah, I would agree. And what I've found in my career, you have a longer career than I have had, but it seems to me every time I talk to an investor or an advisor who says, "Well, I want risky investments and I want to beat the markets," they're generally the first person calling me or panicking when there's drawdown, right? So, I think that there's a place, whether it's a part of an overall model portfolio, to have something in there that can be risk off, and make decisions, and which is what I want to talk about. So, in terms of your risk on and risk off decision making across the book, as well as potentially in your funds, which we're going to get to, how are those investment decisions getting made? Is everything rules based and systematic, or how are you guys going about the process of making decisions?
Okay, so the actual ETFs and funds are very much rules based. And for example, the one you mentioned, it's a good way to kind of start the discussion without really having to get too deep into it. DFRA was engineered by us because we felt there was kind of a gap in the marketplace for um, an alternatives type vehicle that actually had yield attached to it, which is why it's called the yield enhanced real asset um, ETF. And so the philosophy in that, which is the same philosophy, you think about it, it's kind of like the one I kind of grew up with, which was private equity, is that there's nothing better. A lot of the way screens and managers look at companies is wrong in our view in the public markets. And we look at it like private market folks do. We look just at our version of free cash flow.
Okay.
And so if you're looking at free cash flow, you're not looking at manipulated earnings or charges here and there and all the other stuff. It's just basically money that's available for investors. And that methodology is actually built into the screens in DFRA, which is, we're looking for opportunities, which includes REITs, includes companies that are in you would call them more like the commodity businesses in real estate, that actually offer really good cash flow, and then they sort of fit into our philosophy is, okay, how much do we want with oil? How much do we want with real estate? How much do we want with other components like soft components? So that's not dissimilar, right? That's not dissimilar from how you build a commodity ETF. But that first part is. And so what you end up with is you end up with really high quality type opportunities, but the yields you get are also pretty high, and the yield, from our view, is less suspect. It's coming out of cash flow.
Got it.
And so that's the philosophy behind what I call in fact, all our ETF products are built like that. But it's a good way to kind of ground the conversation about how we start to build. And that's the first step. And then the second step is really, okay, now you have these products. There's certain ETFs that are cash flow oriented and others that aren't, but they're all tactical in the sense, and they all, for example, have either signals built into them. In fact, they all do, except one, and I'll get into that in a little bit. And the bottom line is that stuff runs pretty well. And as you probably know, there are times where it doesn't work well, but that's okay, because that's it's at least if market metrics, traditional market metrics, which define elevated risk, are in place, we may miss some returns. That's the way it is. Now, in terms of just the actual doing it, it's an allocation process where we have a lot to choose from, right? And you have percentages you can choose from, and that's important too. So if you decide for example, you may want to switch to an ETF in the portfolio that's in cash or treasuries because you want to raise cash. That's how you do it, as opposed to we're going to sell something.
So it sounds to me, just to get clear on this. So it sounds like you have a rules-based screen that's going out and sourcing opportunities. You have a rules-based way you want to construct this portfolio. In terms of those, kind of holistically, in terms of allocation decisions to what pops up into your screen, is that something you guys do as an investment committee and kind of choose how you want to weight things, or is that also a systematic decision?
Well, once the portfolio gets formed, it becomes more systematic.
Okay.
Because once it's there and it exists, so say, for example, the global tactical allocation portfolio, which consists of Donoghue Forlines products, including the ETF products, a lot of the stuff is working the way it should work. And then the question's going to be, are there other circumstances? This is your engineering point. Are there other circumstances where we need to probably be either more cautious or less cautious? Now, typically, if you think about it, a global tactical allocation portfolio is at neutral, something like 60% risk on, right? Or classic risk on, I should say.
Right.
Because as we now know, it's very possible in a 60-40 portfolio, or in our case, probably since that 60 includes alternatives, it's very possible for everything to correlate, and that strategy is sort of flawed. So that's another reason where you may want to engineer something.
Yeah. The last thing I want to get into before we jump into DFRA is the risk off or risk on signal. Are those derived by looking at certain macroeconomic indicators? Are you combining that with technical quant? Like, you don't have to get into the secret sauce. That's not what I'm asking. But how are those decisions derived, and kind of what things are you looking at?
Yeah. So what happens is they were all built, with the exception of GTA, which is the ones we brought to the table. They're all built around long term, going back to the creation of high yield, market performance, and what happened in those markets. In other words, the indexes themselves are built that way.
Got it.
So the signals that come off of them are historically based, but there's a lot of, this happened the same way each business cycle, right? So that's probably most of what we have. The two of the ETFs, which does include DFRA, are built around the notion that that signal should be probably just around a potential recession.
Okay.
Meaning that's probably the largest drawdown you're going to have, either right before it or during it. And that's when you need that signal to kick in. The others probably have a little faster twitch. And that's more of a function of the fact that if you look in the last 20 years, the incidence of volatility is greater than it used to be. In other
Right.
words, volatility used to be here and then not here, here and not here. Well, now it's almost always here.
Right. Yeah, it seems like the frequency of a 20% drawdown is becoming, every 18 to 24 months at this point, and definitely more instances. So let's talk about DFRA. We touched on it a little bit, but let's really kind of help advisors and investors understand it, which is DFRA is your yield enhanced real estate asset ETF. Can you define for me yield enhanced real assets?
Yes, yield enhanced real assets are basically um, obviously high yielding um, companies, which are comprising the screen. We really start with the Russell 3000 and screen for companies that have high dividends, um, but they are well supported by free cash flow. So that's how the screen initially kicks through. And then, of course, we're looking for a diverse mix in there across all alternatives. You end up primarily with real estate, REITs, and companies who are in the oil transmission business, that kind of thing. But still, it's a consistently high yielding portfolio, and frankly, it's less volatile because of that free cash flow notion.
Yeah,
That's historically that relationship has stayed constant.
got it. Um, so the fund, what is the fund specifically trying to accomplish? I think you just answered this, but are you kicking off like monthly yield, or is that kind of the purpose of owning it? Can you just talk about what you're really trying to fit, or where this is really trying to fit inside a model portfolio?
It's a sleeve product in a model portfolio that actually does contain two aspects. One, there to the extent that we're in periods where alternatives are non-correlated to stocks and bonds, it does provide that, and most of the time it does do that. Like for example, we're going through a period now where that is the case. Um, but if you look at the constituents, which are REITs, infrastructure, oil and gas, commodities, and natural resources, you're looking for strong free cash flow and a high quality of earnings and a high dividend yield. Most people who buy it, and it's interesting because it goes to that notion we said earlier. It's a very popular instrument in this now higher interest rate environment, even where people do want steady yield. So, for example, it's often used um, in retirement portfolios where it does kick off that high yield, and yet it doesn't typically track what else is in there, which includes their typical smattering of stock and bond holdings.
So, as far as communicating with an advisor in a model portfolio, what ETF or holding in there would you most likely try to get them to replace or peel from to add DFRA?
That's a good question. I think the main replacement is your typical commodity ETF, where a lot of times we used to notice that advisors would incorporate, say, oh, I'm just going to throw in, the energy ETF, XLE, or
Mm-hmm.
something like that into a portfolio, and say, look, that now I've got alternatives in here, right? Or they would use ones that were structured of those types of instruments. And so we felt like that was lacking in the sense that, yeah, that might at some point be less correlative to stocks and bonds, but not really. Historically, that's not true. So you have to have the other pieces in there in order to make that even possible. I'm not saying it works all the time, but make it possible. And then there was this notion that almost always we've had great success with yield products. And it's mainly because I don't know if when I first got started, we were dealing a lot with insurance brokerages, and
Mm-hmm.
they're more conservative and they have a lot of people who use them for retirement accounts. I think there's some grounding in that. But nevertheless, I think that's that's still a fast growing business demographically, and it's a place where if you don't have that yield component, it takes some work to figure out what you're doing different.
Yeah. So you touched on weighting decisions. What about rebalancing? How does the fund rebalance? Is there a set frequency, or um, let's just talk about the rebalancing schedule if there is one, or is the fund active?
It's basically done. It's the whole thing's rebalanced once a year, but it's reconstituted monthly.
Okay.
So the reason for that is, and I think that's I had actually had some debates with folks about that when we first built it, and it was, to my mind, if I'd have built this in 2015, I would have had a quarterly and annually, right?
Mm-hmm.
Quarterly recon, annual rebalance. And I just felt like you just take a look at some of the periods we've had, Brad. I mean, think about what happened in the pandemic. We had
Yep.
a 5 week bear market.
5 weeks and 30%.
Yeah. And you had that in 22. You had 22 tech stocks took a dive, and as you pointed out, I think we talked about this earlier, bang, hardly anybody anticipated the route upwards you'd have after such a horrible decline. Usually you have, the battlefield gets picked upon, and the wounded walks out for a while, and
Yep.
and suddenly, a year later, people start saying, gee, maybe there's some value in here. That's not what happened. So that's why we went to the monthly recon, which is, let's take another look now because things are moving too fast.
Yeah, I think that's smart. We've in some of our more strategic portfolios have increased our rebalancing and reconstitution schedules as well, because since the computers have taken over, it just seems like you don't get those periods like you just referenced of, hey, I need to lick my wounds and reevaluate. It's more, we are risk off and we are risk off quickly, and we are risk back on and we are all in rather quickly. I mean, 2020 is a perfect example. I mean, 5 weeks, 30%. And then I think it took 8 or 9 months from trough, but that the first part of that recovery, I think it was 20 some percent, was, I mean, really, really quick. So this is really, really interesting. I want to give you an opportunity to talk about your other two ETFs. You have DFNV, which is risk managed innovation, which I'm excited to hear what that is, and DFHY, which is tactical high yield. So can you briefly talk about those funds and what are the objectives of those funds?
Yeah, they're both built the same way the other one is on a what I call an initial set of screens, and they're built off the Russell 3000, and they get at a free cash flow component. So in other words, the same thing that happens in DFRA happens in DFNV, and to a lesser extent in high yield. High yield's kind of a little easier because you do have credit ratings of companies,
Mm-hmm.
so it's not quite as difficult. But still, what you're seeking in all three opportunities is a little bit higher quality, and so it'll probably knock out a lot of the. In fact, if you're not thinking about it, and we don't think about it that way, but if you're thinking about it in terms of cap weighted, you don't end up with a lot of small caps, right? You end up with mid and large, but that's okay for us, as long as it's getting the characteristics we want from free cash flow. The twist in innovation is that we add a concept known as research intensity, and it's different from a lot of the people say, oh, we're going to add R&D back in because that's how we tell if a company's innovative or not. And our view is that's a quarter of the battle. We're looking, research intensity means that you spent money on research, and perhaps even buying companies that have great research, and you've got new product revenue flowing from that,
Got it.
right? So that's why, for example, yes, every now and then you'll see Apple pop in, and you'll also see a lot of folks like Nvidia will show up in those screens precisely because they have great cash flow, and precisely because they are spending money like you would believe on research, and and are winning with the research. So that's that piece. In high yield, it's I think the secret sauce in high yield is that free cash flow points. It's higher quality junk, if you will, which is kind of hard to describe to people who aren't in the high yield business. But it's the other key to that is like innovation. That innovation has a really deep recession signal built in, and typically won't hit until there's those dynamics play out, which is interesting because it wouldn't have been triggered in the pandemic one, right? There's just no way for a long-term signal to have any kind of effect there, but or have any kind of trigger. And the high yield one has a tighter signal, and that's basically indicative of how that market works. Because a lot of that market, the high yield market, is a lot of hedging goes on between treasuries, high yield, et cetera. And there's a mimicking process of that, so that we're trying to keep with higher duration when it's, when it pays, and then short duration when we think it doesn't.
Well, John, I think you guys have a great lineup of ETFs. It's very interesting on how you built this via the screen first. So I appreciate you walking me through all that. How are you? Obviously, you wouldn't be doing this if you guys weren't out there trying to grow. What are you guys doing in terms of marketing? What's working? How are you finding distribution in terms of getting these three names out there?
Well, I will say this: the pandemic changed everything in terms of how you market. It was already starting to inch up to that even before the pandemic. A lot of the large firms that we compete against had started to cut back on their what I call classic distribution cost,
Right.
which are salespeople in the field. And indeed, as you probably know, we find that the sales function is really accelerated during the pandemic. The not many advisors or product people who are inside of broker dealers want to hear from salespeople anymore.
Mm-hmm.
That's a sea change. That's a big change, and I'm not trying to denigrate those roles. There are roles where that works, but if you've got products like ours and yours that have a story attached to them that are worth the while of the product person or the advisor hearing it, you have to develop different strategies like this one. You
Yeah.
have to have good communication. So we try to do that on a very regular basis. We'll never turn down an opportunity to do that. Now, a lot of that's also allied with the particular platforms that we're on, and where we'll push them to say, gee, how much content do you guys have? Because, by the way, that's, advisors want that. They want to
Mm-hmm.
have something that's recorded that they can listen to in their own home, and they do. So we do not only webinars on what we're doing and how we're doing, we do it on content stuff like, gee, what's really going on with inflation,
Yeah.
and why is it? It's everything seems kind of different now. We'll do those things on a pretty consistent basis too. But I think big challenge is if you don't have all your investment professionals talking to in those communication channels, you're hamstrung
Yeah.
these days. Because again, I don't know of any. I think that's just really super important, particularly again if you're trying to fight against the guys who have large checkbooks who can kind of buy their way into places.
Yeah. It's amazing how quickly after the pandemic, the invitations for the steakhouse lunch by a wholesaler went away. And you're right, it has changed a lot. And in a lot of ways, there's a lot of noise now. So trying to get yourself in front of the right people can be a bit of a challenge. But the last question I have for you before we kind of move on, I saw you guys have a robust lineup of mutual funds as well. Any thoughts around converting those strategies to ETFs, or do you have reasons to keep them as mutual funds? I talked to a manager last week who has a mutual fund as well, and there's certain advantages to keeping it, especially with that moat that's been put around broker dealers, and obviously how mutual funds can provide some economic benefit for the advisor. So, any thoughts about converting those, or are you going to keep running that business strong?
I think we're going to, we like everybody else have culled that lineup, but the bottom line is the stuff that we have we like, and it's in. I think the guy you talked to is right. There are reasons you want to have some mutual funds, and that's why the big firms do too. For example, in the 403b channel, that's what you have to use, right? And we have that channel, some in that channel too, and that's the education channel. And then you also, strangely enough, or maybe not strangely enough, we're big in the annuity business.
Okay.
So, for example, when an insurance company puts together a multi-manager package, we're often included there as a sleeve, and that's a pretty successful business. It's sticky, and it requires a lot of upfront work. But once you do the upfront work, it's kind of stays in there. So those are two main reasons why you probably, again, it's endemic. It's endemic to whatever the firm is, but that's just how we came up in the business, and we want to serve those channels. But if you ask me today, if we're going to look at any new products to build or buy, I would be saying there'd be ETFs, because I
Yeah.
think that market's growing at a faster rate.
Yeah, I would agree with that. So, John, you've been very gracious with your time. Before I let you go, where can people learn more about your firm and your funds?
Go to DonoghueForlines.com, and it's I will say that's another thing. We've built a wonderful set of communication tools, including a website, and you can get fact sheets, all the stuff that you and I can't talk about on the radio about returns and all that stuff's in there, and specific stocks within those ETFs. And again, we're restricted to say you can read it yourself. So that's the best way to do it.
Great. Well, John, again, thank you for your time. I appreciate you being with us, and I wish you the best. And hopefully, sometime in the future, we'll get to meet face to face and have a conversation.
Absolutely. And thank you again for the time and the invitation, Brad. And good luck to you and your firm.
Thank you.